Recently, Bill Ackman talked with Lex Friedman on his podcast, and I wanted to share a clip with you. I had a friend reach out to me and ask me about getting started in investing, and this is really an approach that I want to take is how do you identify a good company to purchase? Let's talk about that really quick by watching this clip and breaking it down.
You mentioned a book, Intelligent Investor by Benjamin Graham, as being formative in your life. What key lesson do you take away from that book that informs your own investing?
Sure. Actually, it was the first investment book I read. And as such, it was kind of the inspiration for my career and a lot of my life. So important book. Bear in mind, this is sort of after the Great Depression. People lost confidence in investing in markets, World War II. And then he writes this book. It's for like the average man. And basically he says that you have to understand the difference between price and value, right? Price is what you pay. Value is what you get. And he said, the stock market is here to serve you, right? And it's a bit like the neighbor that comes by every day and makes you an offer for your house. Makes you a stupid offer, you ignore it. Makes you a great offer, you can take it. And that's the stock market. And the key is to figure out what something's worth. And you have to kind of weigh it. He talked about the difference between, he said the stock market in the short term is a voting machine. It represents speculative interests, supply and demand of people in the short term. But in the long term, the stock market's a weighing machine, much more accurate. It's going to tell you what something is worth. And so if you can divine what something's worth, then you can really take advantage of the market because it's really here to help you. And that's kind of the message of the book.
In that same way, there's a kind of difference between speculation and investing.
Yeah. Speculation is it's a bit like trading crypto, right?
Strong words.
Well, short-term trading crypto. Maybe in the long run, there's intrinsic value. But it's many investors, in a bubble going into the crash, were really just pure speculators. They didn't know what things were worth. They just knew they were going up, right? That's speculation. And investing is, doing your homework, digging down, understanding a business, understanding the competitive dynamics of an industry, understanding what management's going to do, understanding what price you're going to pay. The value of anything, I would say, other than love, let's say, is the present value of the cash you can take out of it over its life. Now, some people think about love that way, but it's not the right way to think about love. But it's, so investing is about basically building a model of what this business is going to produce over its lifetime.
Now, Bill really articulates this point well in this interview, so I'm not going to rehash it all again. But that difference between price speculation versus what the value of something is really important to take away. Because when you have the mindset that you're buying this so that it goes up, when it starts to go down, you have no confidence in it. It's very easy to sell out of it. It's very easy to get rid of it. It's very easy to have loose hands and to not be able to ride the natural waves of the market because you believe in the company. Bill goes on to later in this interview talk about Chipotle and how they had a little bit of a scare in their food markets. And he talked about, hey, every fast food restaurant has dealt with something like this. We know it's recoverable. So when people are scared, we're not going to be scared. This is something we can weather and the company can weather. And so we're going to be behind them. So that's the kind of confidence and conviction you want to set up. Now, it's okay to be wrong and to say, hey, maybe I wasn't right. I need to get out. You're going to have to do that occasionally. But when you make a good decision and a good purchase, it should be one that you can stick with over the long term through the ups and downs. Let's get back to it.
So how do you get to that? This idea of called value investing. How do you get to the value of a thing? Even like philosophically, value of anything really, but we can just talk about the things that are on the stock market.
Sure.
Companies.
The value of a security, the value is the present value of the cash you can take out of it over its life. So if you think about a bond, pays a 5% coupon interest rate. You get that, let's say every year or twice a year, split in half. And it's very predictable. And if it's a U.S. government bond, you're going to get it. So that's a pretty easy thing to value. A stock is an interest in a business. It's like owning a piece of a company. And a business, a profitable one, is like a bond in that it generates these coupons or these earnings or cash flow, every year. The difference with a stock and a bond is that the bond, it's a contract. You know what you're going to get as long as they don't go bankrupt and default. With a stock, you have to make predictions about the business. How many widgets are going to sell this year? How many are going to sell next year? What are their costs going to be? How much of the money that they generate do they need to reinvest in the business to keep the business going? And that's more complicated. But what we do is we try to find businesses where, with a very high degree of confidence, we know what those cash flows are going to be for a very long time. And there are very few businesses that you can have a really high degree of certainty about. And as a result, many investments are speculations because it's really very difficult to predict the future. So what we do for a living, what I do for a living, is find those rare companies that you can kind of predict what they're going to look like over a very long period of time.
Now, Bill Ackman is obviously a legendary investor, but the most legendary probably in this area of value investing is Warren Buffett. Everybody knows Warren Buffett's name, and he has owned companies for decades, and he's just allowed them to return cash to them. And basically his plan is to never sell, right? You can buy a company, plan to hold it forever, and then the only reason to get rid of it is to say, hey, they're up against something long-term that's going to destroy the business, or it's going to make it so it's no longer profitable, or this company is just no longer worth holding. They're making too many mistakes. I need to get away. But otherwise, if you watch and that company continues to make quality decisions, you just let it go, let it ride, because it's going to continue to return that cash. So when you're looking for a business, a lot of times when you get started, it's really common to think, what can I buy now that will go up from here? That was really my mindset when I got in, and probably the mindset of most people. When you get into the value investing side, there's all kinds of ways that a company returns money to you, whether it's through dividends or share repurchases. There's all kinds of things that they can do, or investing into the business to create more revenue, which creates more cash flow, which then they can return to you as well. So one of the key takeaways that we can get for this video, if you're first getting started or you're just trying to figure out value investing, is just that shift in mindset away from, let me figure out what this thing should be worth, versus how can I buy something low and have it go up. I think when you move away from the buy low so it goes up mentality, you'll be able to analyze stocks a lot better if you're looking to make these long-term value investing plays. Hope you found this helpful. Thanks for being here today. Hope you have a great week, and I'll talk to you again next time.